A fascinating week in so many ways. Let's start at the beginning. We're up 3 basis points in 10s minus 2 spread in terms of steepening. You know, it wasn't that many weeks ago we were at -5. Now we're hovering right around 13-ish.
Well, basically we're seeing investor sentiment pivot between the risk-on, risk-off sentiments that we've had in the marketplace. Today happens to be a good day. Trade negotiations seem to be going well. Negotiations with GM seem to be going well. Relatively appeasing the markets. Funding pressures seem to be alleviated. So dollar strength has actually gone subsided. And we're seeing some of that go and bleed back into the markets in terms of higher yields. But I think the ultimate thing here is recognize the fact that volatility in the marketplace still emanates from interest rate exposure at this point in time. The uncertainty, where the Fed is going, how people are going to react to the relatively higher interest rates in the United States.
Does that surprise you though, Jerome?
No, not necessarily, but it really beckons a pivot point that investors need to be focused on being more defensive, especially as we approach year end, and focus on the value in the front end of the yield curve. Most importantly, think about that short term is effectively the new high yield, not in terms of risk, but in terms of income generation opportunities. And it also helps to protect you from the volatility we're seeing in the marketplace.
Even with the Fed buying T-bills, which they don't call QE, that actually is, it's still probably a pretty good bargain. Let's get to interest rates. Now, I know that we were talking off camera, up close to a 1/4 point in 10-year gilts, but that is a whippy market, but still 25 basis points is a percentage of 46 where it started. Wow, same could be said for the Bund. And all the uncertainty, I think, is a function of central bankers never knowing where that red exit sign was. Now we're uncertain, but we're uncertain for good things, because the fact that we're even thinking about an exit, that Christine Lagarde doesn't look like she wants to stimulate more, this is a sea change in terms of the landscape looking forward for interest rates.
It's a sea change, but a slow change. At PIMCO, we've been identifying this, that monetary policy has been exhausted for quite a long time. The ECB has actually moved to the point that they have to embrace and perpetuate the idea that we have to do more fiscal policy. With this in mind, you're going to see a recalibration of interest rates, but it's slow and methodical. On one side, you have people who want interest rate exposure because it's a defensive measure. On the other side, you have to think about the impact to the yield curve around the world and how we're going to effectively adopt to monetary policy, handing off to that fiscal policy over the medium term.
You know,
it's a challenge.
And I get that it may be slow, but I think you may underestimate the growing pains of rising rates. You know, we've subsidized a whole fleet of zombie-type corporations throughout the world. We add in weak institutions with large leverage, and the nervousness emanates in many ways from those entities. To see a Bund go from, you know, what was it, 3.5 weeks ago, -71, it's at -45 today. These are big moves, Jerome.
These are big moves, especially with negative interest rates, especially even where the U.S. has come from. But that's exactly the point. Keep it in mind that the volatility in the marketplace, whether it's emanating from concerns about liquidity, year-end, credit risk, these are all times and periods to be more defensive and be more pragmatic about how you're thinking about it until we get clarity on Brexit, on monetary policy, handing off to fiscal policy.
And more important, your favorite word, diversification.
Diversification and high quality.